My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Mr. David Stockman. So, David, we were having a little bit of technical glitch there, but introduce yourself to the audience. Who are you? What's your background? How did you get involved in markets and in economics? And How did you meet Mr. Chris Martenson?
Well, I've been at this a long time. I started in 1970 working as a staffer on Capitol Hill, became a congressman in 1976, was budget director for Ronald Reagan during his first term. Then I went to Wall Street, eventually became one of the founders of Blackstone. And now in recent years, I've been publishing a daily newsletter on the accumulated knowledge and views I have on all these issues: political, financial, economic, Wall Street, the Fed, what's going on in the world, and so forth. So I think maybe that's a quick 50-year summary there.
And as far as Chris Martenson, what's the connection?
Oh, I was on his show frequently. I'm not sure exactly how we originally met, but he's a very insightful guy, and I've always enjoyed having dialogues with him.
So I want to focus on the word normal for a moment, because it seems like nobody really knows what normal is anymore. Everything is being normalized, but things are not really normal. From your years of experience and work in the Reagan administration, what's considered a normal economy?
Well, I don't even know if we have one anymore, because we've had such a novel breakout of policy. If we go back to the Reagan era, no one would have imagined that the Fed would end up with a balance sheet of nearly $9 trillion, $5 trillion of which came just in the period since March 2020, which is to say they printed more money in 2 years than the first 112 years of the Fed's existence. The budget deficit, the federal debt today at 31 trillion would have been unimaginable. We inherited a debt when I became budget director of 1 trillion, and that was considered a real challenge at the time. The economy is not 31 times larger today than it was then. The debt share of GDP has just soared. So if we look at those kinds of basic policy parameters, we're in a totally different zip code. It's a new ball game, but what has made it especially acute is that since March 2020, when we plunged into the lockdowns and the COVID hysteria, and then the massive back-to-back stimulus, stimmies, as we call them, COVID relief bills, $6 trillion worth in quick succession between March 2020 and March 2021. All of this has flooded the system with so many novel forces and cross currents that my point these days is you can't look at the business cycle or the so-called incoming data that the Fed is allegedly preoccupied with and interpret it in the same way that you might have even 10 years or 20 years ago. There have been such massive distortions that everything's out of kilter. For instance, I wrote the other day, we had this big number for retail sales in January. It was allegedly up 3%. But we have so much inflation, flowing through the system, and we had such a huge uptick in merchandise sales of goods during 2021 because of the quarantines and lockdowns, that the number is not what it appears to be. In other words, I pointed out that retail sales adjusted for inflation in January this year, 2023, were actually 1.8% below where they first peaked way back in March 2021, when the third stimulus package, the so-called American Rescue Act that Biden put through, became effective. So we basically have been flatlining for the last 22 months. Now, that doesn't match with the rhetoric that we heard on the January report that the economy is strong, is the consumer is, healthy and spending like never before. It's the distortion is what the issue is. Then if you go back to March 2021 when it peaked and ask where did that stand relative to the bottom in April 2020 when the lockdowns first hit, you get just a unbelievable answer. Retail sales rose in that 12-month period. I'm talking real here now, not nominal. I'm talking about inflation-adjusted retail sales in that 12-month period soared by almost 50%. I mean, if you look back at the historical series for real retail sales or anything similar, you can't find anything that's even remotely close to a really vertical surge of sales by almost 50% in that period of time. Obviously, what was happening is that people were stocking up their pantries, their shelves, their garages, everything else. They were buying goods hand over fist. And then finally, we reached a plateau, and it's been flat as a board, as I said, for the last 22 months. So you don't see these kinds of patterns when you look at the historical cyclical data, or when you get all these Wall Street analysts saying, well, the Fed has raised rates X number of times since last March, and therefore with a lag or lead of a couple of months that they're guesstimating, we can expect the following to happen. The point I'm making here is you don't know what to expect to happen because we're so far off the historic charts with all these distortions. Now, I just used one example, but you have them over and over. I mean, we had transfer payments, obviously, that just soared when they were sending out $600 a week of extra, toppers for unemployment. Then the successive waves of so-called stimmy checks, the $1,200, $1,400 per person. If you look at how that translated through to transfer payments, it was crazy. The rate, this is annualized rate, went from about 3.2 trillion a year to upwards of 6 trillion in that short period of time when they were just flooding the zone, so to speak, with manna from heaven, or Washington in this case, and people it flowed into their bank accounts. They spent some of it on goods. They couldn't spend it on services because everything was closed down. The rest of it piled up in cash accounts, and now the Fed is trying to slow down the economy, but it's up against this massive increase in cash balances that were inadvertently created in that sequence of stimmies and lockdowns over the last 2 or 3 years. And so the big buildup of cash is now bleeding off slowly, but it's keeping the economy a little more resilient than would otherwise be the case in response to the rate increases. So now we get this question, which I keep going back to, I wrote about the other day, is, well, what's the lag between policy changes, interest rate changes at the Fed, and the macroeconomic effects? A long time ago, Milton Friedman said that the lags are long and variable, which is to say no one knew. And right now we're at a point where they really have no clue as to how quickly inflation will bend to this belated effort to bring, the economy, to break the economy, because there's so many intervening forces, variables at work that have never been there before. I mean, you can go look at the cash balances, which is currency and demand accounts and savings accounts and money markets, and you'll see that that number is up by $5 or $6 trillion from where it's ever been before. So it's that pile of cash that's being slowly bled off Some economists want to call it savings. I don't think it's really savings. It was handouts from the federal government and forced home containment on the part of millions of consumers. But in any event, that's the big elephant in the room, and it's fundamentally changing the pace at which all of this unfolds. The bottom line is that we're going to have high rates, far higher and for far longer than anyone anticipates at the present time because of these novel factors at play. And therefore, the vaunted pivot is going to save Wall Street from a time of misery where it doesn't get its, monetary juice is going to last for a lot longer than anyone anticipates.
And that cash balance, that cash on the sidelines, for lack of a better way of saying it. I mean, I think the real concern there is, what if you were to have a sustained pickup in the velocity of money, right? Because then all of that could unleash a tremendous inflationary wave, and presumably that's also what the Fed is trying to get ahead of.
Yeah, I mean, they're trying to get ahead of that, but I don't think they have factored in. In fact, I know they haven't. The fact that it was there in the first place, because otherwise, it wasn't a mystery. In other words, these facts about the extra $5 trillion sitting out there. I think there's like 18 trillion of cash and currency balances when it might normally be 12 or 13. I could be off a little bit, but I know that 5 trillion is the difference, which is the key thing. That wasn't, hidden somewhere. That wasn't a mystery, as they were keeping their big fat thumb on the scale through March 2022 and continuing to buy $120 billion a month worth of bonds and GSEs, and keeping, interest rates targeted at practically zero in nominal terms and very negative in real terms. That $5 trillion, elephant in the room was sitting right there. They should have known. They should have seen it. They should have understood that that's very abnormal, that's a huge economic aberration, and that it would be troublesome if it ever got unleashed. But what did they do? They kept making excuses as to why they didn't want to raise rates. And then finally they started raising rates, and everybody talks about this is the biggest, most sustained rate increase since the early 80s. Well, that's a lot of baloney. I was there in the early 80s. And when they started raising rates in the early 80s, the funds rate was already, just a little south of 10%. And it was raised from that level because that's the only thing that would bring inflation to heel. But when you start at zero and you get a little over 4%, where we are today, in an inflation environment, which is still running, I insist, 6 or 7%. I mean, they can pick and choose and find some, so-called super core CPI that excludes almost everything and shows that the number's a little lower. But, as I wrote yesterday, I swear by it. I like the 16% trim mean CPI, because that includes everything. It doesn't say forget energy or forget food, or now they're dropping out shelter, and so they're getting to core, super core. Inflation doesn't mean anything. But if you take the 16% trim mean, which every month drops out the high and low, but it's a different high and low each month, you have a smooth measure of where the inflation trend is running. And last month it was 6.7% year over year and 7.0% on a annualized rate basis in January. And even if you take the 3-month annualized rate ending in January, it was just a little above or under 5.5%. So no matter how you measure it, a valid, reliable measure of the running inflation rate is in the 6 to 7% zone. And if you have the funds rate barely, pushing towards 5%, you still have very negative real rates. And that's the problem that's going to be with us for quite a while. I happen to was there when Volcker came into office in August 1979. He inherited real rates that were about where they are today, negative 2-3%. And he proceeded to push the nominal interest rate, both in the money market and longer term, relentlessly upward until real rates touched on 8 or 9 or 10% by the middle of 1981. Now that broke the back of inflation, but that's what it took back then. I'm not sure it'll take that kind of, drastic change now, but we're not even close when we look at the data and see that the real rate in the money market today is still -2. They've got to get to +2, 3, 4 before they really slow this thing down.
But don't they want that negative rate? I mean, that's how you can eat away at the high leverage on the government level.
Well, there's that argument that there's some kind of sinister conspiracy on the part of somebody. I don't know exactly who that is. Maybe it's people, civil servants at the OMB or, staffers on Capitol Hill that want inflation in order to depreciate the government debt. But, that's only an attribution. It's not a motivation. They all have every kind of excuse imaginable. The inflation is transitory, or there's longer lags than we thought, it'll come down, or we're trying to balance a lot of different objectives and we have to do this, for the public good. They got plenty of excuses, but no one is saying that we're trying to depreciate the debt. That may be the functional consequence, but it's not relevant because it isn't what drives motivation. It isn't what drives decisions by policymakers. Now, the policymakers at some point are going to panic, I think, because they were promised that inflation was going to cool really fast. And, there were people running around saying the battle is almost won because if we take the last 22 days worth of inflation data and annualize it and drop out this, that, and the other thing because, they're aberrationally exaggerated at the moment that we have inflation almost down to 2%, the battle's over. Well, that's just a lot of malarkey. The inflation is deeply embedded, and no matter how you measure it, including shelter, and I think we could easily talk about that because I think it's important. We're still stuck in a 6+ zone when for about 8 years between January 2012, when Bernanke officially embraced inflation target, where they set up the magic 2.00% target as an official goal. Between them and right on the eve of the COVID, disruption, the inflation rate ran about 2% when you measure it the way I think you should, which is the 16% trim mean CPI. So where we stand today is with a running embedded inflation rate 3 times higher than where it had been during that long stretch of time during the post-crisis recovery. And that is a real challenge because 6% plus inflation just wipes out savings, wipes out wages in a very short period of time if it's allowed to persist.
Just to reset the room for the remaining minutes, everybody on the Twitter space, please, even though David Stockman is doing this via Zoom with me, you can follow him on Twitter. Check out his various books as well. And if any of you want to come up and ask questions, click that bottom left mic request button. Why is all this negative for equities? So I keep going back to, I think a lot of these narratives are simply not based in history. rising rates, stocks can rise in rising rates. 41% of new all-time highs happen in rising rate environments. Even in the 70s, sure, the real rate was relatively low, but you still have positive equity returns in the 70s. Why is it that that's perceived as bearish for beta?
I think it's because maybe the market has one thing right. I don't, the market changes its judgment every day, so it can't be right every day. But in any event, the Fed has become so dominant in the financial system, especially since Greenspan sort of inaugurated the current policy regime of wealth effects, and all the other nonsense that went with it. But it's become so dominant in the financial markets that basically equities price off whatever, messages and actions are emitting from the Eccles building, and almost nothing else, in my view. And so therefore, if the data is emerging, suggesting that the Fed is not going to pivot hard and pivot lower soon, it's going to be negative for equities because the market is pricing the Fed. The market isn't pricing the GDP. It's not pricing the S&P 500 earnings flow over a period of time. I mean, all of that stuff gets rationalized. It gets factored in after the fact, but day to day, week to week, the market is pricing the Fed. And that's a terrible thing. It's a terrible, terrible, terrible thing. If capitalism is to be vibrant, if we're to have, real, solid, sustainable economic growth and wealth creation, then you need vibrant, healthy capital and money markets. And that means markets in which millions and millions of traders and investors and savers and speculators and everybody in between are determining what prices are for financial assets. And that isn't going on today. And that means that capitalism is essentially sick. It's been badly impaired by a dominating, arrogant central bank. And as a result of that, we're going to have big trouble for a long time to come.
Since you hit on wealth effects, let's tie that into shelter, because I think the Federal Reserve itself would clearly admit that the wealth effect is more targeted towards home values than stock values, right? Because more people own homes than stocks. Where are we in terms of the housing cycle? I talked to a lot of different people on these Twitter spaces. Some are of the opinion that you're going to have a massive influx of new inventory that will cause a crash in housing values. Some think that housing is going to stay sticky for a while. What's your view on things?
I think there's been a huge misunderstanding on the disconnect between the so-called OER, the owner's equivalent rent factor in the CPI, and you put that alongside the rent of primary residences. You put those two together, it's 24% of the weight in the overall CPI, the headline, and 40% in the core. So that's huge. And what there have been a lot of commentary about is that if we look at the private real estate services, like, say, the apartment list index or Zillow or any of the others, the rate of housing inflation, rental inflation soared, in the high teens, even low 20s on a year-over-year basis, mid-year last year, late last spring, and has now come down quite rapidly. And some people were looking at the month-over-month changes in these indices, particularly apartment lists, and from August on, the rate month over month was negative. And so the argument became, rental inflation is done. It's over. It's now turning negative. The stupid CPI is 12 months behind. It'll catch up. Before long, we'll have zero inflation because that's such a big weight. And the Fed will be, slamming on the accelerator, and, stock market will be happy again. Well, that was a total misinterpretation of that data. That data was not seasonally adjusted. And I pointed out in something I published a couple of days ago that if you look at the last 4 or 5 years, and a lot of these series don't go back much longer than that because they're newly innovated things offered in the private market because there's a demand for it. But if you look at it every year, beginning in the early fall, month over month, rates go down because the business of renting apartment units apparently is very seasonal. And then when the new rental season opens up again, late winter, early spring, rates month over month rise strongly through the summer. But if you take the seasonality out of that, which is really what you should do, and recognize that that is measuring only new contract rents and not the entire rent roll. In other words, if rents tend to have a term of 1 year, then those private indices were representing 1/12 of the national rent roll, whereas the CPI attempts to proxy for 100% of the national rent roll month after month as changes in the market work their way through. So the bottom line of this is the CPI took the edge off the upside. It never got more than 7 or 8% when the private indices on a new contract basis were in the high teens. And now that they're coming back to 3, 4, 5% year over year, that is the new contract rents, the CPI is going to continue to run 6 or 7. It was almost 8% last month, the year over year, until all of those rent increases of the last couple of years anniversary their way through the system. The net of it is the CPI wasn't that wrong. It basically just flattened out the rental inflation impulse. But, we're not heading, as I look at these numbers, we're not heading towards zero or negative shelter rents. In fact, the latest data is for the apartment list index. And in February, it was up at about a 4% annual rate. So the seasonality is coming right back. The normal seasonal uptick, which you can see year after year, is back in February. And I think in the next couple of months, rental rates will be positive on a month-over-month basis. And this whole delusion that shelter rents are going to, collapse and save the day will be, revealed as a big error.
What can the fiscal side do to help alleviate inflationary pressures? I'm not talking about the Inflation Reduction Act, obviously, right? But what can actually be done? So, I mean, even on the housing side, you can argue that, okay, maybe that you can do targeted stimulus towards home builders to create incentives somehow to build more. Okay, granted, it's all zip code dependent based on red tape on the local level, right? But what kind of things can be done from a government level?
The government can't do anything, okay? I mean, how much more damage does anyone want the government to do? There's $6 trillion worth of stimmies in March of 2020, and then another one in December that Trump signed, and then the Biden. I mean, this was a catastrophe. It flooded the marketplace and households with cash that most people didn't need because either they were at home and couldn't spend, or they were continuing to work from home and had a paycheck and no place to go with it. So the thing was a colossal mistake. That's where all this inflation came from. Now, to say that we're going to have another anti-inflation stimmy to compensate for the pro-inflation stimmy that we've already had, I think is just, wacky. I mean, it's just nonsense. The federal government needs to get its house in order. We have a horrendous fiscal outlook built in for as far as the eye can see. the new numbers that just came out a couple of days ago from the CBO, which is about as official as you can get, show that over the coming 10-year budget window, that we will add 20 trillion of cumulative deficits to the public debt, will be in the mid 50 trillion range by the early 30s. And we're heading into a time where I don't see how you grow your way out of that kind of massive further increase in the public debt. So they need to forget about the here and now of whether inflation is 7% or 4%. They have to get their nose back to the grindstone of how we close this massive gap between built-in spending, which is heading towards the high 20% of GDP level, versus built-in current law tax revenues, receipts, that are roughly 18%. So you've got a 10% of GDP deficit built in by the 2030s, as far as the eye can see. And there's just no math. There's no economic theory other than, crackpot theories that suggest you can somehow sustain that kind of year after year debt addition and have, a healthy economy. You're either going to have an attempt to monetize the whole bloody, massive, mess and really blow up the system, or you're going to have the Treasury in the bond markets, in the bond pits, just absorbing so much of the available supply as to crowd out everyone else, drive interest rates far higher than people imagine. And, that won't be very salutary either.
I want to touch on your book, The Great Money Bubble, Protect Yourself from the Coming Inflation Storm. What are the hedges to all this, right? So I keep going back to stocks, can still do okay in that environment. Housing's a driver of inflation, and you can argue a hedge against inflation. Is it as simple as that, or are there other things that people should be thinking about in terms of dealing with tomorrow?
Yeah, those are good points. And unfortunately, this inflationary tidal wave is so great. It's not just in the goods and services CPI. I mean, we've had massive inflation of financial asset prices for the last several decades, but especially since the bottom in 2008. I note in the book, for instance, that if you look at the NASDAQ 100, which is the leading edge of the stock market, that's where the big tech high growth game is played. But that was up at the peak last fall. The market really peaked in late 2021. But that was up by 1,250%. That's a big number, 1,250% from the December 2008 bottom. During that same period, from that bottom to the end of 2021, nominal GDP grew by 55%. So when you have the market rising about 23 times faster than the nominal GDP, you're in an unsustainable situation. Another way to say it is the market got way, way, way ahead of itself in terms of sustainable income and earnings on which stock prices ultimately depend. So I think we're heading into a period where, you're going to have a secular correction of a massive bubble that was created by central banks, not just the Fed, but all the rest of them, working together in the decade after the so-called Great Financial Crisis. But that also means that certain other hedges that traditionally people thought were good during periods of inflation won't be so hot. And the one that I really focused on is real estate, because it is true that during the 70s, real estate was a pretty good inflation hedge when we had these huge sustained increase in prices. But what people forget is that we started that inflationary era with properly priced debt and therefore properly priced real estate values. After all, real estate more or less prices off yields. The reciprocal of debt cost is the real estate value. But in any event, because we started with no real estate bubble and we started with reasonably rational prices for both residential and commercial real estate in the late 60s, real estate values inflated faster than the general CPI, and so people came out ahead. Now, today, we're upside down relative to, let's say, 1968. Today, we've had such massive repression of interest rates, and we've had low rate, unsustainably low rates for so long that real estate got way overvalued simply because debt was so cheap and real estate is owned on the margin by debt. So today, as we go into, or we're in the midst of this inflation, real estate prices are going to come down because interest rates are going to go up and up and up and continue to go higher for far longer than people expect. And so real estate is going to be a bad hedge, not a good hedge, because it started way over priced.
The thing is, I feel like you can say that about almost everything except commodities, right? I mean, it's called the everything bubble for a reason.
Yep, exactly. I think that's exactly right. And so, the idea that you can't find a good place to land is a little disconcerting to people. But on the other hand, it's not totally crazy. Because if you've gone through a sustained multi-year, multi-decade everything bubble, well, then by definition, there isn't much left that didn't, get the tap on the shoulder and, become the hot asset class for a moment. Cryptos, ETFs, you can just pick any ones you want, the FANGs, the FANGmen, different variations. Earth gains, I think, are going to happen much more on the liability reduction side than on the asset appreciation side. After all, net worth is the difference. And what we're facing now is rising liability costs, carry costs, and falling asset prices. And the thing to do, obviously, in that environment is to cash out, fully valued or overvalued assets, pay down the liabilities, and try to ride net worth at least where it is today, or possibly even a little bit higher. But the whole idea that we build wealth on the liability management and reduction side rather than on the asset side is very foreign at the moment, because for several decades now, essentially, the system, not every investor, but the system as a whole has been borrowing money in order to buy assets and arbitraging the difference. And that's the big thing that's going to change, I think, for a good while to come.
Yeah, I mean, basically, it's pay off your own debts. That's a guaranteed rate of return that's higher than stocks, bonds, or housing.
There you go. Yeah, you said it very succinctly.
I think that's a good place to wrap this Twitter space up. Everybody here, please make sure you follow David Stockman on Twitter. I'll have this as a podcast on all your favorite platforms. Thank you, David. Thank you, everybody, for joining here.